Introduction. Hey there, welcome to our video on IPOs. In this video, we will take a closer look at IPOs, or initial public offerings, what they are, how they work, and what you need to know if you're considering investing in one. What is an IPO? An IPO is the first time a company offers its shares for purchase. It's when a private company goes public and offers shares to investors for the first time. Why do companies go public? There are several reasons why a company may decide to go public. One of the main reasons is to raise capital. By selling shares in the company can raise a large amount of money from investors. This can be used to fund growth, research, and development or to pay off debt. Another reason is to provide liquidity for existing shareholders. Before going public, the company's shares may have only been held by a few individuals, often the founders and early investors. Going public allows these individuals to sell their shares on the open market, providing them with liquidity and realizing significant gains. How does an IPO work? Before going public, a company typically hires an investment bank to act as the underwriter for the IPO. The underwriter is responsible for helping the company determine the offer price for the shares and selling the shares to investors. Once the price has been determined, the company will file a registration statement with the Securities and Exchange Commission, SEC, outlining the terms of the offering. This statement includes information about the company's business, financials, management team, and any risks associated with investing in the company. Once the SEC approves the registration statement, the company will begin marketing the shares to potential investors. This is typically done through roadshows, where the company's management team will meet with potential investors to discuss the company's business and answer any questions they may have. After the marketing period, the shares are sold to investors in what is known as the primary market. Once the shares have been sold, they begin trading on the open market, where anyone can buy and sell them. What should investors know before investing in an IPO? Investing in an IPO can be exciting, but it's important to research and understand the risks involved. Here are some things to keep in mind. IPOs can be volatile. It's common for the price of a newly listed company to fluctuate significantly in the first few days or weeks of trading. This means that there is a risk of losing money in the short term. Not all IPOs are created equal. Some IPOs are for well-established companies with a proven track record, while others are for newer companies that may have a short history of profitability. It's important to carefully review the company's financials and business model before investing. The underwriter may have conflicts of interest. The investment bank acting as the underwriter for the IPO may have a vested interest in ensuring the shares are sold at a high price, which could mean that they are only sometimes acting in the best interests of investors. Consider the lockup period. After an IPO, there is typically a lockup period where existing shareholders are prohibited from selling their shares. When this period ends, a flood of shares may hit the market, which could depress the stock price. Conclusion. So, there you have it. IPOs can be an exciting opportunity to invest in a newly listed company, but they also come with risks. If you're considering investing in an IPO, do your research, understand the risks involved, and carefully review the company's financials and business.